share my screen here so you guys can see my PowerPoint that I kind of put together for it, and we'll dive into some of the material pretty quickly. So if you guys see me looking over here, then it's probably because my monitor, or rather my secondary monitor, is kind of off to the side. That's where the screen is, where my PowerPoint is. But I'll be going through the material as we go through. All right, so the first thing I wanted to talk to you guys about, this is going to be a case study in multifamily real estate investing. So for those of you who are on here, you might have heard about multifamily or investing in multifamily, or maybe you've never heard about it before. And so I want to kind of go over some basics behind multifamily and some of the reasons why I like investing in multifamily, and then I'll talk to you about a little bit more about the case study that we did. We actually just closed on that property December 14th. So we have a lot to cover during that piece of it. So just to kind of give you a little bit about my background, I'm the owner of 5 non-surgical orthopedic specialty medical clinics here in South Carolina. So I have one in here in Columbia, South Carolina, Greenville, Charleston, Fort Mill, which is the South Charlotte market, as well as in North Augusta. So that's where I kind of got started before I went into the real estate. And that's the reasons why I'm in real estate is due to those clinics. And we'll cover that here in a minute as well. I also have a couple other online companies and a couple other spinoffs. I have about 12 different entities that I have right now in different places that are providing me passive income. So this is just one tool, one piece of my passive income. And right now our portfolio of multifamily assets consists of 1,353 doors across $125.3 million worth of multifamily real estate. I also started a group about 3 or 4 months ago called the Multifamily Investor Nation. It's a group I put together for people who are interested in passive investing, but also or wanting to get into the active investing side of things and want to learn more about the educational piece of that. You can go to our Facebook page to find out more information about that. Just go to multifamilyinvestornation.com and there'll be a link there to the Facebook page. We also have a YouTube channel which has a lot of free content on there around multifamily training. We don't do coaching or mentoring. My purpose of the group is really to educate people and bring everybody together in the multifamily space. Obviously, some of the other goals for the Multifamily Investor Nation is to find passive investors, as well as people that want me to be able to help them with some of their deals with some of the loan requirements, which we'll talk about that here in a minute as well. And then, of course, I already talked to you earlier about the Tough Decisions podcast. I won't go into that very much, but you can go to toughdecisions.net to figure that out. Also, I am married. So I'm married and have 4 children. So I always like to kind of show a few, recent photos of the children so you guys can kind of see that I am actually a real person and actually go out and have some real fun. So that's my wife and I up there in the top right-hand corner in Chicago, Illinois. She had never been there, and we went there this past year on our 10-year anniversary. So we've been married for 10 years. Of course, you have my son Caleb there in the middle. He was wearing a suit and went to an event with me. So I like to have him travel with me when I go and speak at other events around the country, which is kind of cool. And then on the top left-hand corner there is my wife again and our daughter, our most recent daughter, Callie. She is now almost 12 months, almost a year. So she's 11 and a half months right now. And then at the bottom down there, you can see beside me on the ride, to the right of me is my daughter, Caroline. She is our oldest. She is 8 years old. I didn't mention my son, Caleb. He's actually 6 right now. And that, yes, is my daughter on the right-hand side looking through a Jacksonville, Florida market overview pamphlet. So she was wanting something to read in the car, so I handed that to her, and she had a blast and had a lot of fun. So that's Chloe, and she is 2 years old right now. So we definitely have our hands full and enjoy them quite a bit. But just want to kind of give you behind the scenes there as well. So I want to talk to you about why you should consider investing in real estate and really why I like investing in real estate. So first off, I'll say it's one of the most recession-proof investments. If you look back in 2008 and see when the market crashed, where a lot of other assets were having higher default rates, the actual default rate was about 4%. So even though that might seem low, 4% was the average default rate in all the asset classes around that time frame. And so in multifamily, though, it was 0.4%. So it had a very low default rate, and it also it was also one of the first assets to recover after the recession as well. And the reason why is because when people aren't able to buy houses in a down economy, what do? They're forced to rent. And so it makes it a much more stable asset class to be able to invest in, because it's an asset that does well in a down economy and also does well in a good economy. And there's actually two other types of assets, or one's not an asset, but there's three things that do well in a good economy and in a bad economy. Number one is multifamily real estate, because of the reasons I just stated. Number two is self-storage. So we don't do any self-storage, but it's definitely another opportunity and asset that I would suggest that you consider, because in a down economy, people are downsizing and they need a place to store their junk, so they need storage. Same thing in a good economy. In a good economy, it's the opposite. People are buying and expanding and growing, and they're buying a bunch of stuff, so they need to store it somewhere. And so it's always a good asset to have, multifamily and self-storage. The third one, can you think of the third one, Thomas? I know I have you on mute there. I'll give you a second, but can you think of the third one?
The third one, the third
Not
asset.
real estate.
It's not real estate. Is it? I'm trying to think. Is it ATM machines? Maybe I don't.
It's alcohol.
Alcohol.
Yeah, so that's one of those things that's really in a good and a bad economy. So I know you weren't expecting that, so I thought I'd try to see what you were thinking there. So the next thing one of the reasons why I like multifamily real estate is because of capital preservation. It's one of those types of things that whenever you're investing in the stock market and various avenues like that, you don't have capital preservation. And with these types of assets, you do have that capital preservation. It's not guaranteed, but it's very easy in these larger multifamilies, which is what we invest in. We only invest in 100 units, 150 units or more, minimum 10 million in acquisition. And so when you start to get into those larger scales, you definitely have that lower risk of preserving the capital at the very least. Most of our projections, which we're going to go over some of the projections on what you should be looking for before you passively invest in these deals, we're going to be going over some of those different pieces so that you kind of know what are the targets that you should be looking for. The third thing here is going to be about potentially doubling or more a self-directed IRA or any type of a qualified retirement plan, if you will, whether it be a 401k, IRA, and of course, when we're talking about non-cash IRA, we're also referring to that as well. So we're talking about that passive income. But basically, in most of these projects that we're putting together, the projections are showing a doubling of your initial investment over a 5-year period. Now, again, it's not guaranteed. But that's usually what the initial projections are. And a lot of times we can hit those projections sooner. Just depends on how the market's doing in the economy and whether or not we can sell sooner rather than later, and where the cap rates are following. And we'll go into some of those terminologies that I'm throwing out there here in a minute too. So for those of you who are on that might not know some of the lingo that I'm throwing around, you'll have a little bit better understanding of that. So obviously the next thing is passive income. So passive income is always nice to be able to invest in something and then not do anything at all and then just collect the checks or get the wires or the deposits every single month. So that's always nice. I have somebody who's invested with us that recently quit her job because she had been in that job for 25 years, and she recently quit her job because now she has enough income coming in from her passive investments that she doesn't have to work anymore. So, and she's actually bringing home the same amount of money that she was when she was working full time. But now she has even more. And you could probably talk about this more, Thomas, from what we talked about a little while ago, is about the actual losses that you can take depending on your qualifications and statuses and stuff like that. So I'm sure he can help you with that after the fact, if you will. The next thing is the tax benefits. So obviously you have depreciation, you have standard depreciation, you have accelerated depreciation, and then bonus depreciation. So the standard depreciation is when we buy one of these properties, and what we call a multifamily syndication. That's where we are pooling multiple investors' money into one deal. And so for those of you who might be looking at this going, I can't buy a $10 million property. Well, I can't either by myself, right? So that's why we do what's called a syndication, where it's not a criminal syndicate, if you will, or anything like that. It's a syndication where multiple investors can come in on the same project or the same investment or same deal and be able to put in money into it. Usually the minimum investment is $50,000. There's usually a maximum as well, depending on what the lender requirements are. But typically minimum 50,000. And I'll go over the deal we did recently and talk to you about the investor spread and stuff like that. So you kind of know how many investors were in it and stuff like that. So that's typically how that works. But when we buy these larger properties, we do still get standard depreciation. And even though some people would consider multifamily large, 130 unit, 150, 230, 300 units as commercial investments, technically, I guess it probably would be considered a commercial investment, but not for IRA, but IRS, depreciation, tax purposes, instead of being taxed at the 39%, or to being at the 39% depreciation table, it's actually at 27 and a half years. I think it's 27 and a half. Isn't that right, Thomas?
Yeah, it's 27.5 years for residential property.
And so it's at that 27.5%. Year depreciation schedule on the standard schedule. So obviously, there's things that we can do, which are called like cost segregation studies, where we can hire outside engineer firms to come in, piecemeal the property down to the sheetrock and the studs and the cabinets and the countertops, the flooring, the fixtures, all of that, and do what's called accelerated depreciation. And some of the pieces inside the property can be depreciated at 5 years to 15 years, somewhere around in that range. And then, of course, you also have the ability to have bonus depreciation. So certain things that you do on a capital expense project where you're improving the property, renovating the property, some of those things can be expensed 100% that first year. So there's definitely some nuances there. I'm not a tax professional, nor am I an attorney, so I don't play any of that on TV either. But for those of you who are interested in that, I'm sure Thomas could fill in some of the gaps offline or whatever. And I'm sure you probably have done some webinars on these various pieces of depreciation, and so you can touch base with him about that. So any questions coming through about that, Thomas?
Not yet. Just to let everybody know, if you do have questions, you can hit the Q&A box and just simply drop a question in. We'll go ahead and make sure that gets answered. You can also use the chat box, but yeah, if you need to.
Awesome. Well, I'll go on here to the next slide that we have coming up. And let's see here. All right, so I want to go over some multifamily underwriting tips. So I'm not going to get into the nitty gritty of going through a PowerPoint of like the spreadsheets and all the different numbers and going through a T12 and a rent roll and offering memorandum and all that kind of stuff. I don't think we have the time to do that, but I wanted to go over a couple of things that you guys might need to be looking for from a passive investor standpoint, as well as if you decide to get into the active side and the active role of investing in multifamily real estate, some of the different terminologies that you're going to use, and then we'll go over some of the criteria that you should be looking for, whether you're looking to do active or into the passive side of things. So the first thing I'll point out is the internal rate of return. So the internal rate of return, that IRR, which is what it's commonly referred to as, the best way to think about the internal rate of return is to think of it as a return on your investment, but it's different. So ROI, that return on your investment, is basically saying that you put in 20, you get 20 out, or you put 20 in, you get 40 out, you got a 100% return on your investment, or some people might look at that, go 200%, depending on how you say it, but you got money, you got a return on your investment. Now, I'm going to play a little bit of game with you, Thomas, and see how you would respond to this. You'll probably catch on, but maybe we'll see how it goes. All right. So, Thomas, if I told you that I put $100,000 into one of these deals and I got $200,000 out, is that a good deal?
It depends on a lot of different factors. How long was the money in the deal for?
That's the biggest key. So that's the thing that ROI, just looking at ROI, doesn't put into the calculation, is the time. Because I could have said I got 100,000 out, and I could put 100,000 in, I got 100,000 out, but it took me 20 years. Now that's a terrible investment. But if I told you I put 100,000 in and I got $200,000 out of it, and it only took me 5 years, now that's a phenomenal investment, right? So it definitely, you passed the test there, Thomas. So that was great. So yes, you want to make sure that you're looking at that time value of your investment, not just I put in 100,000 and I got 200,000 out. You need to really be watching that. And that's where internal rate of return comes into play. And that calculation is a very advanced calculation, typically done by an Excel spreadsheet where you're typing in the numbers year by year or month by month or even day by day on those returns to investors and the initial equity and balancing it off. Usually starts out as a negative IRR until all the initial capital is returned, and it goes to a zero. And then from that point forward, the IRR starts to go up. And so we'll go through some of the criteria that we always look for on that internal rate of return. But just think of the internal rate of return as an ROI, return on your investment, but also baking into it the time. Okay. And so the next thing is the cash on cash return. So the cash on cash return, which is commonly referred to as the COCR. Usually we just say cash on cash return. Unless we're writing it out, then we put on there COCR. The cash on cash return is the amount of money that you are actually taking back and putting in your pocket that's based off of your initial equity. So if you put $100,000 into a deal and every year you're putting back into your pocket $10,000, that would be a 10% cash on cash return. So it doesn't have anything to do with the income or the expense ratio or anything like that. It's how much money you have been returned back based on your initial investment. Okay. The next thing is the cap rate or the capitalization rate. The capitalization rate is based off of the value of the property and the actual cash flow coming off of that property, okay, or the actual money that's actually being made off that property. And it's not necessarily have anything to do with your initial investment. It's basically saying that if we have a $10 million property and we have a $1 million that are being returned to us off that property, we're getting that would be a 10% cap rate. If we're getting $500,000, then that would be a 5% cap rate. But cap rates are really important, but at the same time, they are really not important. So, the way I always look at that is cap rates are important to understand that in a particular market, the market sets that cap rate. So in these larger multifamilies, when you're trying to do a valuation, you don't value these properties off of, looking at all the different properties around it that's sold, because it doesn't usually happen that often. So typically what they do is they base it off of the income on the property and the cap rate in the market. And so you take that NOI, that net operating income, the way you come up with that is you take your income and subtract out your expenses. That's going to be that NOI, that net operating income. And then you divide that net operating income by the cap rate, and that gives you the valuation of that particular property. And where this comes into play and where it's really important is upon the business plan on the property to renovate the property or improve the property to a point where you can start to charge more for rent or add other components or amenities to the property to allow you to increase your NOI, that net operating income. And that's really the key factor. And the cool thing about this type of real estate is that every time you increase that NOI by just $1, it exponentially increases the valuation on the back end when you sell. And so to give you an example, I prefer buying in what we call lower cap rate markets, where you're in that 5%, 6%, 7% range, because you actually have more ability to increase your return on that whenever you sell. And here's the example, and the reason why is that if I buy a property, doesn't matter what the size, let's just say it's 150 units, and my cap rate is at 8%, okay? And I increase the NOI on that property by $100,000. That's great. That's a phenomenal increase. That's a great $100,000. I have increased the value of that property by $1.25 million. But if I bought that property in a 5 cap market, in a 5% cap rate market, my valuation would be $2 million. So I've increased the value by over $750,000 just by investing in a market that had a lower cap rate. So a lot of times investors look at this in the very beginning, especially the ones that are active, and they go, I want to buy the highest cap rate possible. And unless you're paying cash for the property, that makes no sense. Like, you shouldn't be doing that. You should be looking at what's the best opportunity for you to increase that NOI in a lower cap rate market, because you'll be able to look at the back end. Now, again, if you're a buy-in, like long-term hold, like 10, 15, 20-year hold investor, these are totally different conversations that we have to have. But most of the time, we're holding onto these properties for about 5 to 7 years. And so when we look at that, we want to make sure that we can exit in a low cap rate market to increase that valuation. The next thing here is the debt service. So the debt service is the mortgage payment including, I'm not putting these things up, is the mortgage payment, including the principal and interest. Okay. So the debt service is basically taking what the calculation of how much it's going to cost you for your mortgage payment, really, because that's going to be including that principal and that interest payment. Now, a lot of times on these loans that we're getting, which we actually were able to get what are called non-recourse loans, which we'll talk about here in another bullet. These are typically are done via Fannie Mae or Freddie Mac, and they are usually sometimes 5 to 10 year fixed rate loans, and you can get probably anywhere between, on the low end, about 1 year, but most of the time we're seeing between 3 to 6 years of interest only, and sometimes more. Just depends on the lender and the property and the market and various things like that. So it would only really include interest in the beginning, interest only period. But when we're calculating what is called debt service coverage ratio, typically we're including the principal, even though we're not paying it, because the property needs to make sure that it's going to be paying for the debt once that comes into play. We don't want to ever have the property get to a point where it can't pay its debt, because then we have to give it back to the bank, and we don't want to do that. And so the debt service coverage ratio is a calculation or a multiple of how much but cash flow is there to be able to pay the debt service. So if I have a $50,000 debt service and I have $50,000 in income, then I would actually have a 1. It would be a 1, if you will, in a debt service coverage ratio, because that means I have just enough money in my accounts to be able to pay for that debt. And typically, if you have to go below a 1 debt service coverage ratio, then we're talking about going into different types of loan products, like a bridge loan. And then you also have, whenever you close on that property, you got to put interest reserves in place. And so there's a little bit more of a risk involved when you start to talk about bridge loans. But this is what we try to target for is to have a debt service coverage ratio over a 1.0. And so if that same example, if we have, a $50,000 debt service, we have $100,000 in income, our debt service coverage ratio would be a 2. Most lenders, Fannie Mae and Freddie Mac, want to see about a 1.25 to a 1.35, and that is all based and dependent upon the market that you're investing in, and you're actually the market that you're taking that debt on in. And so the lender is the one who sets the requirements of the minimum thresholds for that. That's definitely something you have to look at. So non-recourse debt. One of the other benefits of having having investments in these larger assets is, one of the questions you might be thinking is, well, if I invest in one of these large assets like this, well, what happens if somebody slips and falls on the property, or there's a fire or something happens? Well, there is, and the bank takes the loan back or whatever. These are all done with what's called non-recourse debt. So even the people who are putting the deal together, like myself, who are key principals and sponsors, even we are protected from that, because these are non-recourse debt. This is non-recourse debt. Obviously, for slip and falls and fires, we always make sure we have insurance in place. And of course, the lenders require us to have this type of insurance in place. We have umbrella policies, and we're definitely fully covered when it comes to that. But when it comes to non-recourse debt, one of the things that has to be in play here is usually 3 things. Number one, the person who is sponsoring, or what's called the key principal or loan guarantor on this debt, has to have, number one, the net worth of their total net worth has to be the minimum. Has to be the total of the loan balance. So if you have a $10 million property, you're getting 75% LTV. And again, this is just simple math, not including closing costs and all this kind of stuff. But you have a $1 million property. This should be a $10 million property, and you have 75% loan to value. That means you have to have somebody on the team, on the active general partnership side, that has at least $7.5 million in net worth. And so in order to be able to purchase that asset, the second thing you have to have is at least 10% of the loan balance in liquidity. So they have to be able to have liquid assets of at least, in that example, of a $7.5 million loan balance, of at least $750,000. And of course, liquidity can be various types of things like stocks and bonds and stuff like that. But they have to have that available at all times. So they actually, when we sign the debt on these properties, we were saying we're going to maintain that net worth, and we're going to maintain that liquidity. And so obviously you look at this. The third thing is experience. You have to have experience managing these types of budgets, this large of a budget, and you also have to have experience managing these types of assets as well. And so those are the three requirements in order to get non-recourse debt. You have to have those types of things on the general partnership who are actually putting the deal together. And even though it's non-recourse, they still have to guarantee the loan, because there are definitely carve-outs in there for what we call bad boy carve-outs for fraud and embezzlement and various things like that that could get you in trouble. And of course, if we sign on the loan on one of these types of assets and it goes south and the bank has to take it back, the other downside to these is that even though that's non-recourse, and the other downside is that you will never be able, not never, it'll be very hard moving forward to be able to be the loan guarantor on a future loan like this. So I know some people who have waited 10 years to get back on again, and they've done it, but it takes time to build that track record back up if you actually do have a property that goes south. So there are some downsides to this, and it's not always just the negative side of it like that. So any questions about this particular side or anything like that have come through?
So we do have a question from Phil M. Do you have time to explain how a lower cap rate gets better return at an exit in a formula using an example you stated before?
Sure. Let me pull up a I think I can do a board here if you have those available for it. Let me see.
Can we do a board?
Whiteboard. Yeah, here we go. I got a whiteboard right here. Can y'all see this whiteboard?
I can see it.
Hi. Okay. All right. So I clear that. Clear all drawings. All right. Let me do this. So if we have, let's just say we're investing in, let me do black because it's a little bit easier to read. If we are investing in an 8% cap rate, right? And upon exit on a property, we're always looking at a property. We always are trying to expand the cap rate. So if we buy at an 8 cap, we're probably going to be exiting at like an 8.5 or a 9 cap, just on our projections, because we're going to project that the economy and the market is going to be a little bit softer when we sell. Now, obviously, we like it when it stays at an 8 or whenever our entry is, or even goes lower. But when we're doing underwriting to stay conservative, we always try to exit at a higher cap rate just to be conservative. So for this example, we'll just stay at 8% because I already have those numbers in my head and kind of know those. So at an 8% cap rate, if you have invested, not invested, but if you have increased the NOI, and you've increased the NOI by $100,000, okay? So you have this NOI that's been increased by $100,000. When you go to sell that property, if you've increased the income by $100,000, okay, let's put a little cash symbol up here. You increase the income on that property by $100,000. You have increased the value of that property by a whopping $1.25 million, which again, still phenomenal, great investment, not bad, but it takes me the same amount of time, energy, and investment to increase the NOI on an 8% property at $100,000, an increase at $100,000, than it does on a larger property or even the same size property at a lower cap. And typically, that basically means that instead of investing my money in a tertiary market or a quaternary market where it's in a city that maybe no one's ever heard of, and then I'm going to be investing more in a primary or a more popular secondary market, so you're going to have some more compressed or lower cap rates. So that's going to be the example of an 8% NOI increasing by $100,000. Let's do that same calculation, but do it at a 5% cap rate. And so again, we're going to buy it at a 5 cap, but upon exit, we're going to still probably project it's going to be 5.5 or 6, depending on the market. But you've increased that same thing, $100,000, just like it was above, right? And same thing is going to be increasing the NOI. What you now do upon exit when you sell, that property is now going to have an increase in valuation of $2 million, not 1.25. So that really is the benefit of investing in a lower cap rate market. It's not necessarily just the entry, because yes, you're going to pay a little bit more in the beginning, but because it's a low cap rate market, the chances of you being able to sell at a low cap upon exit are much, much higher. So even if you buy at a 5 cap and you're able to sell it right at a 5 cap, you're going to get that $2 million. But let's just do the calculation like this. So let me clear this board real quick. Do the same numbers, but let's just do the 8%. Let's just say we're going to exit let's just actually do this. We're going to say this is going to go to a 9%. Just to be conservative, and then this one's going to go to a 6%, right? So we can look at these same numbers, same calculation, 100,000. I'm going to take that $100,000, and I'm going to divide it by the cap rate that we're going to exit at. So we're going to divide that that $100,000. We're going to divide that by 0.09. That's going to get us right at 1.1. So a little over 1.1. So it's 1.1 approximately, okay? And then if we exit the same property, $100,000 at a 6 cap, that's going to be 1.6. Okay. So again, you can see my dots off place, but you can kind of see why lower cap rate markets are better investments, because upon exit, the amount of effort and work that you put in is worth more when you sell than when you're in. So hopefully that was helpful. Any other questions that come in?
Yeah, we have another one. Hi, what's your source of cap rate? I understand that it is subjective.
Sure. So yes, the cap rate is it's subjective, but it's not. It's really market specific. So when you're talking about how do I find like the cap rate that should be available for, say, Atlanta, Georgia, well, the best way to figure out the cap rate is to, one, ask other investors in the area what they're seeing. Number two is ask other brokers what they're seeing, and also some of the larger brokers like CBRE, Marcus and Millichap, Cushman and Wakefield. They publish usually yearly and then also quarterly reports on the projections and also the history and the trends behind markets in the cap rates in certain markets. Now, again, if you're in a smaller market, they're not going to track some of those smaller markets, like Florence, South Carolina, or, some of the smaller markets around the country that you may have never even heard of. They don't usually track those very closely in these larger national reports, but you can look at, ask your brokers to pull comps, not necessarily for exact valuations, but try to find out what the cap rate would be. So if you figure out what that cap rate is based on the comps, which most of your brokers should have access to data to give you that information, you can come up with what the average cap rate is that is selling in your market. So one property down the street might have sold at a 6, and another one down the street might have sold at a 6.5, another one might have sold at a 6.2. And so you kind of have a good idea as to where you would fall in line. And so when you do your underwriting, you can figure out, am I in the ballpark of what that market's going to be and what it's trading for at that cap? And so a lot of times you just have, it's really kind of a guessing game. And that's where I think maybe the subjectivity comes into place. But it really is looking at the data that's available in that specific market and diving deep and asking questions to the people that really have that information.
And I guess just to ask a quick question myself on this, I guess like the cap rate would probably be subjective based on also like it's determined by the market, but it has to do with supply and demand too as well. Like, I mean, if there's a huge demand for these properties, then the cap rate is going to drive the cap rate lower. Whereas if there wasn't so much of a demand, it might drive the cap rate up.
Sure, absolutely, and where you're basically looking at that is if you have a lot of if you looked at the market and you said, and this is kind of how the cap rate changes, is basically on the demand. But if you have a property that is being sold and the typical cap rate range in that market, let's just say as a 6 to 6.5, to use that example I had earlier, and you have 30 people bidding on the same property, well, the person who gets the lowest cap rate bid on that is going to get it. And so over time, what that does is it causes the cap rate in a market to continue to compress and to continue to go down, because somebody might come along and go, yeah, the market cap rate is 6 to 6.5, but I really want this property because I know I can increase the value by X. And they might bid it at like a 5.8 or a 5.9. And because of that, they're going to get that property. And so it definitely, has a play into the demand. And right now, these properties are in very high demand. And so even this property that I'm going to go over here shortly, it actually had about 30 to 40 people that actually put a bid on this property. And so I actually lost it to begin with because there was another group that bought it and that got it ahead of us. And because we stuck with our original number and our original underwriting, the broker actually called us back 4 weeks later and said, "Hey, the original buyer was inexperienced, couldn't get the job done. Do you want it?" And we were able to get that property. And it's a phenomenal investment, a phenomenal deal. But that's one of the things that you have to look for is that cap rate and how it actually compresses, because it is constantly moving. It is a constant target, and you have to understand where you're going to come in at in order to make the best offer.
Absolutely.
All right, let's move on to the next thing here, which is the criteria. So I'll just run through this real quick, so it's not really that hard to go through. Typical criteria that we look for is 1980 to 2005 vintage, so built in the 1980s to 2005. The reason why we like that is because if you go a little bit farther beyond past the 1980s, then you start to get into some other issues like asbestos and different piping issues, and so it kind of plays into how you have to look at that property a lot more detailed. And the property we bought in Greenville, South Carolina, which I'm going to cover here in the next slide, was actually a 1970s product. So we had to do a little bit more due diligence and checking on certain things and stuff like that. So this is our criteria. We do kind of go one way or another just based on where that property is and stuff. But that's kind of the general rule we try to stay in, is 1980 to 2005. And that's usually what they classify properties as A class, which is your really nice luxury high-end properties built recently in the last 5 to 10 years. Then you have your class B properties, a little bit older, have a little bit of more wear and tear on them. Usually your blue collar or lower end white collar will live there. And then your C class properties is usually your blue collar, standard blue collar tenants or whatever, and that's going to be your properties that have been built, around that 1970s, 80s, 90s, and that 1980 to 2005 range is when you're going to really see those. And then, of course, you have Class D. I'm not going to get into that because I don't invest in Class D. We don't look at anything in Class D. We're not interested in Class D. That's where drugs and all that kind of stuff happens. So we don't want to be in that type of a market, of that type of a neighborhood. There's a lot of other nuances that come into play there, and not very many people want to buy in that kind of a market. So when you're buying these types of assets, you always want to have the exit in mind. So know who you're going to be selling the property to once you renovate, once you put the value play into place. Otherwise, you buy a Class D property, put a lot of money into renovating it, increasing the NOI, and you can never sell because nobody wants that asset. So you have to make sure you balance the exit strategy in place as well. The cash-on-cash target that we look for is approximately 10% on a 5-year hold. Typically on our investments, the investors, and we'll go over this in a minute, receive an 8% preferred return, which means that they get an 8% return on their initial investment before there's any share with the people who put the deal together, which we consider the sponsor or the key principal. So we're typically targeting at least a minimum 8%, but usually on a 5 to 7 year hold is about a 10% cash on cash. So you put $100,000 into a deal year over year while we're holding the property, you're going to get approximately $10,000 in residual cash flow off that initial investment. And then, of course, when we sell the property, you would get more than that. That's how you're going to have that equity multiple that we're going to talk about here in a minute too. IRR target, that internal rate of return, we're looking for about a 15 to 18% return on that 5 to 7 year hold. The equity multiple is about a 2x. So you put $100,000 in, the cash flows plus the proceeds from sale will be at least a 2x multiple on your money. So you put $100,000 in, $200,000 you'll get upon the exit. And then one thing we already talked about this is making sure that you focus on that entry and exit cap rate. Great question from the person who asked that question earlier as well, because I was going to cover a little bit about that a little bit later. But the entry and the exit cap rate is definitely very important, and to conservatively underwrite a deal. And if you're vetting other sponsors or people who are putting these deals together and doing this, you want to make sure that they're exiting at a higher cap rate than when you entered the market, when you bought the property, to make sure that the underwriting is conservative. So we typically have a rule of thumb of about 10 basis points spread every year we're into the deal. So if it's a 5-year hold, it's a 50 basis spread. If it's a 70-year hold, if it's a 7-year hold, we're going to do a 70 basis spread. So that's basically, if we enter at a 5 cap on a 5-year hold, we're going to project that we're going to exit at a 5.5. Now, in most situations, we do more than that, but that's like the minimum that we will do. And if the underwriting doesn't work at that minimum, then it's not a deal for us. We have to pass. We have to move on. So that's usually what the minimum is that we're looking for, is that 10 basis point spread on each one of those. Of course, knowing the sponsor before you get into one of these deals is very important, and making sure that they have a track record of being able to execute on a business plan. So obviously I have a background in multifamily, but also a background in business and being able to manage a $10 million plus budget and managing over 50 employees and have a lot of experience with that. And so, I'm a very good person to be able to do these types of assets because of that, because of my background and because of my track record with that. But you want to make sure that if you decide to go invest with somebody else on another type of one of these projects or deals, that they have a track record of success, and ask them those hard questions. How long have you been in multifamily? Have you executed a business plan before? What is the success that you have in your background? And make sure you have and found some sort of success in their background. Next thing here is the investment summary that I want to go over a little bit. I just took out a few select slides for you guys to look at. This is a property that we just closed on December 14th, 2018. Took it over. This is that one in Greenville, South Carolina called Hampton Forest. We are actually doing a lot to this property. We're putting a $1.9 million renovation into it, so about $13,000 a door, which is a very large amount per door on this type of an asset. But we're doing a complete reposition. So a reposition is taking it from a Class C property, that blue-collar property, to a higher property class, which is going to be a B-class property. So this will be attracting more of your lower-end white-collar and your higher-end B-collar, your blue-collar tenants. So it'll be a much higher quality property, and I'll go over some of the things we're going to do on the business plan on this property too, so you can kind of see what we're planning on doing with it. Next slide here is this executive summary, which is typically inside of each one of these investment summaries or executive summaries that we actually have. So first thing I want to go over is this thing right here, which is called the cap rate. That's cap rate is based on the previous T12. The T12 is the expenses of the last 12 months. And so this particular property, we entered at a 5.27% cap rate. So it is a low cap rate. The reversion cap rate right here, which is the exit cap rate, which is what we've been talking about earlier, is at a 5.95%. So that you can see that this one is definitely going to be at that same kind of criteria, but we're actually going to be exiting about 50, a little bit more than 50. So about a little bit less than 70 basis point spread on the entry and the exit cap rate, which I think on this deal, when we first underwrote it, the numbers for returns were just so far throughout the roof, like 25, 30% IRR, that in order to make it make sense to investors, because a lot of times investors look at a 30% IRR and go, there's no way that that's going to happen. You basically just have to modify the underwriting to make it even more conservative. And so this one's an even more conservative deal because we're actually exiting at larger than 50 basis spread on that 5-year hold period. The next thing here is the expense ratio. And again, this is based off the previous T12, which is provided to you by the property. And some of the larger assets that we're in, they are usually fairly accurate because they use software programs, property management software programs, because they have on-site property management and various things like that. So this one is at 49%. And that basically means that the income and the expenses has about a 50-50 ratio on the amount of income you're going to have off the property or cash flow off the property versus the expenses. So if you have 100,000, this right here would basically be 100,000 in income and 49,000 in expenses, and that's where you get that 49% expense ratio. And so we have to watch that expense ratio as we're going throughout time on our underwriting spreadsheet. We break it down by month. And every month we're watching that expense ratio throughout the entire 60-month hold period. So the spreadsheets can get pretty detailed and intense because of that. It's also important to understand that when somebody is underwriting a property, you cannot just underwrite a property based on the year. You have to underwrite that property based on the month, because things change over the time of the month. So if you're going to project that, year one, you're going to increase the rents by 3%. Well, you're not going to just all of a sudden day one be able to increase everybody's rents by 3%. You have to base it off of the rent roll and how many tenants each month are being turned over. That way you can modify your spreadsheet accordingly. The next thing here is the debt service coverage ratio. We talked about that. This one's really good. It's at 1.53. The purchase price on this one was $8.9 million. And then, of course, we put in $1.9 million in renovations. And then the hold period on this one is a 5-year hold period. The equity that we were required to have upon acquiring this property was $2.43 million. So we ended up raising right at about $2.5 million on this property. And because this deal was a really solid deal, great markets. I actually grew up in Greenville, South Carolina, so I know this market very well. This particular asset, we were able to raise the $2.5 million that we needed for the property within about a 4 to 5 day period of time. So investors really liked this one. It's a great asset. I myself invest in all these deals as well as my partners in these. We invest alongside all of our investors because that's the reasons why I did it to begin with, is because I wanted to have a place to be able to put my money to be able to offset some of my income and offset some of my taxes and various things like that. The next thing here is the equity multiple. We talked about this earlier. On this one, it was a 2.33x. So you put $100,000 in, 5-year mark, $233,000 will be the total aggregate we're taking out. Now, we also break it down by the investor average annual return, which is 10.3%. And that would basically be that cash-on-cash return that we're looking for. And then the cash-on-cash return, when you include the average annual return, which includes the sale proceeds, increases because you're including the profit you're making upon the sale as well. So that was 26.6%. And then, of course, the internal rate of return, a whopping 20.8%. So this was a very, very good deal. And that's why a lot of the investors liked it at the same time. So almost time for some more questions. I'm going to go through this business plan that we have on this property real quick. I wanted to also go over this too. I forgot I had this slide in here. So this is basically an example of what to expect on a $100,000 investment broken out by year. So year 1, 8%, year 2, 10%. Year 3 is at 10%, and year 4, you can see there is at that 11%, and then year 5 is at that 185%. It's 185% because it actually does include the sale proceeds at the end. So the next thing here you can see is again just highlighting the amount of return you're going to get off that $100,000 investment each year. And then the partnership structure on these deals is typically, like I said earlier, an 8% preferred return and then a 70-30 split. So 70% of the deal of the investment goes to the investors, 30% goes to the people who are putting it together. And then sometimes that split can vary, 80-20, 75-25, just depends on the deal and how solid it is. But I would definitely encourage you to make sure that you invest in deals that definitely have a good enough split for the partnership, for the general partners, because you want to make sure that their interests are aligned with yours. And at any point in time, you don't want them to feel like, they're not getting a fair share for all the energy and time and effort that it takes to put these deals together and to run these, because you are passive. You're not doing anything. You're just putting in the money and that's it. Now, again, you are doing something because you're putting the money in, but you have to understand that there is definitely a lot of work on the back end for these types of properties. And you want to make sure that there's a fair split and a fair share as well. The second thing here is the membership ownership. So that's basically just reiterating the 70% that's going to be going to the investors. And then that's going to be 70% up to an 18% IRR. So 70% is going to investors up to an 18% IRR. Once it hits the 18% IRR return, then it gets split 50-50. So again, it's just aligning the interests with the general partnership and the LP, the investors, the limited partners in these type of projects. So this is just the business plan that we did and put together in the summary. I'm not going to go over into this too much detail because I know we're running up against the clock here. But we basically are doing a complete renovation on these units, investing interiorly about $8,000 a unit, and then the rest is going to be spent on the exterior. So we're going to be doing a lot of different things to this property, completely renovating and changing it, and it's going to be a phenomenal asset once we're done with it. So obviously the exterior and common area improvements. We're going to be improving the efficiency of the operations. And so right now we have hired a management company to be in there managing the asset. We were using a company called Eastland Management. They're going to start to use some more modern and up-to-date things into managing the tenants and getting the leases turned over a lot faster, and renewals and various things like that. And there's also going to be a potential and a possibility of maybe reducing some of the staff due to those efficiencies, which just allows us to increase the NOI really without doing anything as far as increasing anything anywhere. You just have to decrease it. So there's a couple of ways to increase NOI. You either have to do something to increase the rents or increase the money that the tenants are paying with extra amenities like valet trash, where they pay like $20-25 a month for you to go by and pick up their trash and put it in a dumpster so they don't have to. Or the easiest way to do it or can sometimes be the easiest way, is to try to look at where you can cut and shave expenses. So if you reduce the expenses, it again increases the income and increases that NOI. So I want to make sure you're looking at it that way. And of course, this particular asset has a bridge loan on it. So of course, we're talking there in this business plan about mitigating risk with a bridge loan. We actually got a 3-year interest-only bridge loan that has options to extend it for 2 additional years. That way, if for some reason the market turns or something changes and we need to hold on to the asset a little bit longer, we can. And so the typical thing we try to do there is to try to have those optional extensions as needed. And then we also have the ability to cap this rate, because usually on a bridge loan, there's a floating rate. And so we actually bought a cap on this, an interest rate cap, so that if the caps do go haywire, we're stuck and we get this when we kind of get at that lower cap position. And of course, there is the exit strategy, which I talked about earlier. We're going to be hold on to this property for about 5 years, and that's typically what we do, a 5 to 7 year hold period. If for some reason we get to the exit and we can do it sooner, like at 2 or 3 years, we still hit the same returns, if not better, then we may consider exiting there as well. But the same thing applies when you're trying to exit the property in a down market or a down economy. If for some reason around that 4 or 5 year mark when we're trying to exit it, if for some reason the market's not in a position to exit, then we'll hold on to it for another year or two, or however long it needs to be able to hold on to it to make sure that we exit in a good economy or a better economy than just trying to sell it just because we said we were going to sell it. And that again goes back to what I was saying earlier about why I like the investments, because these investments again have capital preservation in play. And when you have capital preservation in play like that, where you can hold on to a property in a down economy and then sell when it's right, that's also important, and that's also part of that capital preservation. So this is just kind of a recap of some of the reasons why you'd want to invest in multifamily real estate. I'm going to go ahead and open it up for questions right now. I think that's at the end of it. So hopefully I timed that just right there, Thomas. Any questions that have come through?
Yes, we have another question from Phil M. And I think you might have answered this in going through it, but which type of deal do you look for, value add versus yield?
Sure. So when you're talking about yield, you're probably talking more about not doing anything to the property, and just basically buying it for what we call like a core property, where you buy the property, you don't do anything to it, and you're just hoping that over time you can increase the rents that will allow you to be able to have that increase in the NOI. So there is that in the play. There's not usually as much of a return on those. Those IRRs might be closer to like 11, 12, 13%, maybe even lower than that sometimes when you're talking about those. Those are sometimes usually held a little bit longer, maybe like a 7 to 10 year hold. But we typically look for value add plays. We're looking for properties that have some form of deferred maintenance or some form of, classic thing we look for is as a C property in a B area where we can renovate those interiors that haven't been touched since the 70s or 80s and renovate those interiors to get them back to a modern interior. And then we can actually increase the rents on those by $100, $150 a month or even more. And that increases that NOI on the property. And that's really what we're looking for. So the value add plays is definitely where we're looking at. There's also other opportunities that we call like core plus, but they're really the ones we're looking for are those value add plays. The cream, or not the cream, but the diamond in the rough that we're always looking for is those C-class properties in a B-class area, or a B-class property in an A-class area where you can do those renovations and then really increase the actual or reposition that property.
Awesome. So we have another question, one from Austin. Chris, he asks, ways you could look to increase NOI, I know you might have gotten to this, with other than raising rents.
Sure. Yeah. So, one of the things that you have to look at, and that's one of the things that we try to do is figure out, based on the tenant base that you have there, what are some things that you can add to the property that you can start to collect more from. So to give you an example of one of the things that we're doing on this property in Greenville is we're actually adding to the property valet trash. So right now the tenants are basically having to take their trash to the dumpster. And there's like 3 or 4 dumpsters all over across the property. And actually, number one, makes the property look terrible because there's trash dumpsters everywhere. But it also, some of the people don't take the trash out, so because they don't want to walk to the dumpster, or maybe it's raining or whatever. And so what we actually have an outside company that'll come in, and we basically pay them, I think, maybe like $10 a month or something like that. We charge the tenants $20 a month. And so we get to collect that spread, keep that spread of $10 a month. We do nothing other than tell the tenants that this is what we're adding. And they basically will immediately day one start to do it for all the tenants. And then over time, when the rents are when the renewals are coming up for the leases, that's added into the lease, and they're starting to pay that increase for that amenity. And so that's one of the ways that you can increase it is adding an amenity like that, where they actually come in for that $20 a month. Get this, for $20 a month, they come by every single morning, Monday through Friday, and stop by their door, and they have to put the trash outside or whatever. They pick up their trash by 8 o'clock every morning. So by 8 o'clock every morning, they have to have it out. They have to have it out by 8 o'clock, I think, and they start picking it up at 8. By like 8:30, 9 o'clock, all the trash is picked up, and they don't have to go to the trash anymore. So they just put it outside. Every day they pick it up, and it doesn't cost us anything just because we're actually improving the property. So now we're consolidating our dumpsters from being all over the property to just one location, and that company comes in and just dumps it all into one. So there's a beautification piece to that, but there's also a value play of increasing the NOI that way too. Obviously, you can decrease expenses by if you have 4 people on the property and you really can get away with 3 people, or if you have somebody on the property who's just not being efficient, you can maybe get somebody different in there and make somebody part-time that can be more efficient. There's also other things like when you look at a property that has utilities, sometimes utilities are all paid by the landlord or by instead of the tenants. And so you can do a program, what we call it's called RUBS, a ratio utility billing system, or you can have each one of the units sub-metered and start to bill the actual utilities to the tenants. And that's, again, another way to increase that NOI. And so there's all kinds of neat things when it gets to these properties that you can consider. We've even considered, we haven't done it yet, we've considered having like a quarterly food truck day where you get all these different food trucks to come in, and they give you a percentage of the revenue that they collect off of those trucks to be able to come in once a quarter or whatever and provide, have like a little, community event where you have dinner and have all these food trucks, and the tenants are coming in buying food, and you're getting a spread off of that too. So there's lots of different ways to do that, or even having there's so many different things like that you can do, rev share things, but also laundry service. People who don't have washer and dryer hookups in their units, we have on-site laundry, on-site coin laundry. It's not really coin anymore. They use credit cards and little cards and stuff, but those are the things that you can also add as well. So there's a lot of different pieces and nuances to looking for those value add plays, but hopefully that gives you a few ideas to be able to kind of see what we are doing with it.
Awesome. I think you gave a few good ideas out there for people to think about who are going to get into this. Unfortunately, we are running out of time. It is about 3 o'clock. So would you like to give any parting words before we depart today?
Sure. So, obviously for those of you who have been joining us, you've seen on the screen, I have a website there, passiveinvesting.com. If you're interested in possibly becoming one of our passive investing partners, or maybe you just want to see some of the properties we're putting together and maybe consider it down the road, you can certainly join our email list there. You just go to passiveinvesting.com, pretty easy to find that. And there's a little form there that you'll fill out, and we'll put you on that list. And if you have any questions for me, you can shoot me over an email. Just shoot me an email at dan@passiveinvesting.com. Or if you'd like to call me, you can call me as well. My cell phone is 404-316-8550. I'd love to jump on a call with anybody who's interested in passive investing. But even if you have questions on active investing, I'd be glad to help you out with that as well. Thank you so much, Thomas, for having me on. I really do appreciate it.
You too. It's been a great time. And everybody, this will be on YouTube, so go ahead and check that out. Thanks again, Dan.
Thank you.
All right. Bye now.